Most people think the problem in retirement is that they do not have enough money. That is only half the truth. The more dangerous problem is that they do not have enough cash flow at the exact moment they need it. I have watched people spend 40 years building a portfolio and then ruin their own math in 2 bad years because the market fell, their bills did not, and they had to start selling pieces of their future at the worst possible prices. That is how wealth gets quietly dismantled, not always through one spectacular mistake, more often through a series of forced sales made in a bad mood, under bad conditions with bad timing. So when somebody tells me that a portfolio can now be built to send you a paycheck every Friday, I do not start by asking whether it sounds exciting. I ask a much older and much harder question. Does it reduce the chance that you will be forced to sell your assets when fear is highest? That is the question that matters. Everything else is decoration. For years, many people treated monthly dividend funds as if they were the gold standard of income investing. Before that, they waited around for quarterly checks and convinced themselves that patience alone was a strategy. But the world keeps changing. Tools change, structures change, markets change. If you are still investing with an old map, you may feel disciplined while walking in the wrong direction. That is one of the quiet lessons in this market. I have seen investors fall in love with an income idea. A ticker, a story, a routine, and then behave as though the product itself must survive simply because the need is real. It does not work that way. Need is real, products are temporary, the market does not care how attached you are. If a fund cannot survive, it disappears. There were investors not long ago who thought they had their weekly income solution figured out with names like TGAF or WKA. They went looking for them later and found ghosts. That is why you never build your financial life around labels. You build it around principles. And the first principle is simple. The foundation of an income portfolio should not be built for excitement. It should be built for durability. If you understand that one sentence, you already understand more than most people chasing giant yields on the internet. The trouble with modern investors is that they begin at the wrong end. They do not start by asking how to protect their principal, how to cover their baseline expenses, how to make the next market drawdown survivable, how to build a floor under their life. They start by asking how to get the biggest payout immediately. They begin with appetite instead of architecture. That is how people end up owning instruments. They do not understand, with tax consequences they never modeled, tied to risks they only discover after the check stops looking magical. I do not mind income. I like income very much. What I do mind is confusing income with safety, frequency with quality, and novelty with wisdom. A payment that arrives every Friday can be a powerful tool. It can also be an expensive illusion. The difference lies in what is generating the payment. If the answer is short-term United States government obligations, we are having one conversation. If the answer is leveraged volatility, option premium stretched to the edge, or some promise so juicy it makes your judgment go soft, we are having a very different conversation. The attraction of weekly payments is not hard to understand. People want rhythm, they want regularity, they want the emotional relief of knowing cash is coming, they want the utility bill covered, the grocery bill handled, the little sense that their capital is working while they sleep. There's nothing irrational about wanting that. In fact, the older I get, the more I think cash flow has a psychological value that textbooks underprice. Money does not only buy things, it buys calm, it buys time, it buys the ability not to do something stupid. And one of the stupidest things a person can do is sell good assets in a bad market, because there is no cash cushion between them and Friday. That is why sequence of return risk matters so much. Most people do not feel it while markets are going up. They feel it when markets are down. Expenses remain stubbornly alive. And they discover that what looked like a healthy retirement plan on paper was really a liquidation plan in disguise. If you need cash and your only source of cash is selling shares, then your portfolio is not paying you. It is being dismantled to feed you. Those are two different experiences, and the difference between them shapes the quality of a retirement far more than most people admit. So I understand the appeal of a weekly cash machine. What interests me is not the marketing angle. What interests me is whether we can use that idea intelligently. And if I were building that foundation today, I would begin where serious people begin when they are trying to stay solvent, sleep well, and keep their ego out of the way. I would begin with Treasury-backed instruments, not because they are glamorous, because they are useful. One of the cleanest ideas in this group is the Roundhill Weekly T-bill ETF WK. At bottom, this is not a story about getting rich quickly. It is a story about lending money to the United States government for very short periods, collecting the interest, and receiving that income on a weekly schedule. The underlying holdings sit in a ladder of Treasury bills, generally maturing between 0 and 3 months. That matters because short maturities tend to keep price volatility low. You are not reaching far out on the curve. You are not pretending to be clever about long-duration interest rate bets. You are collecting a modest yield from one of the safest corners of the market and getting paid every Friday for doing it. That is a completely sensible building block. The yield may hover around the mid-3 to low 4% range. The fee may be about 0.19%. Those numbers will not start a cult, but that is exactly why I like them. They are ordinary. They are understandable. They do not need poetry to justify themselves. If a person put $50,000 there, the weekly distribution might roughly cover a utility bill, some groceries, a tank of gasoline, maybe a little more depending on the week and the yield. It is not a Ferrari fund. It is a dignity fund. That distinction is important. A lot of wealth is built when you stop asking the wrong asset to do the wrong job. Your foundation should not be expected to make you feel brilliant. Its job is to make sure you do not have to behave desperately. Another interesting tool is MMKT, the Texas Capital Government Money Market ETF. This one is useful for a different reason. I think of it as emergency liquidity that refuses to be lazy. A traditional bank account often gives people the illusion of safety while quietly paying them very little for their patience. MMKT tries to solve that by sitting almost entirely in cash and government securities while paying on a weekly basis. Its 7-day yield can run around the low 4% area. Its expense ratio is around 0.20%. Again, nothing dramatic. That is the point. If I have money that absolutely must be there, money for taxes, insurance, near-term living expenses, capital I cannot afford to subject to heroics, then I want that money in a place where I can respect it. A proper emergency reserve is not a pile of idle cash for people who lack imagination. It is a strategic asset for people who understand that liquidity is what turns volatility from a crisis into an opportunity. When everybody else is forced to sell, the person with liquidity gets choices. That is why I have never understood the macho disdain some people show toward conservative instruments. They act as though prudence is proof of small ambition. In my experience, prudence is what allows ambition to survive long enough to matter. Then there is TLDDR, the newer laddered Treasury. Bill approach, the appeal here is slightly different. Instead of simply holding the shortest paper and calling it a day, the managers have some freedom to move along the front end of the Treasury curve, generally still staying inside a 6-month window. The projected yield can look very similar to other short bill approaches, perhaps high 3s to low 4s, with an expense ratio around 0.20%. What you are really buying is a bit of flexibility in a world where short-term rates can move, expectations can shift, and a rigid rule sometimes leaves money on the table that can make sense. I have no religion about the exact wrapper. I care more about the economic function. If a fund is doing the plain work of converting short-term government paper into weekly cash flow and doing it at a reasonable cost, then it deserves consideration. It may not deserve blind devotion, but it deserves consideration. Now, let me say something that almost always separates the grown investor from the child in an expensive suit. Not every Treasury-themed weekly payer belongs in the same psychological bucket. C proves the point. This one may still be tied to Treasuries, but it is not the same kind of beast as the short bill funds. It uses leverage. It aims to provide 120% of the weekly return of long-term government bonds. The yield may look lower than some of the short-end products, perhaps around the high 2s to low 3s, while the fee is much higher, around 0.99%. And because long-term bonds are highly sensitive to interest rate changes, leverage adds a layer of instability that many people will not respect until the market punishes them for it. That does not make it evil. It makes it specialized. If a person has a clear view that rates will fall, and if they understand duration, price sensitivity, and the role of a satellite position inside a broader structure, then perhaps they use something like this in moderation. But if someone tells me they want a low-stress foundation, I do not send them first to a leveraged long-duration bond strategy with a near one. Person fee. I send them to simpler ground. The order matters. The sequence matters. Foundations first, enhancements later. If you reverse that order, you are not investing. You are decorating a house before you pour the concrete. There is another issue people ignore because it is less fun than imagining Friday deposits, taxes. You can destroy a perfectly respectable yield by being careless about where it lives and how it is taxed. Treasury income typically has a useful advantage for people in high-tax states because it is generally exempt from state and local taxation that matters. But those weekly distributions from Treasury-based funds are usually ordinary income at the federal level, not the lower qualified dividend treatment people like to dream about. If you are in a high bracket, you had better understand that before you start treating the headline yield as the yield that will actually change your life. Real wealth is not built on gross numbers. It is built on what survives friction. Taxes are friction. Fees are friction. Bad behavior is friction. The beautiful thing about a properly designed floor is not merely that it pays you. It changes the way you think. Once you know that your baseline expenses are handled by conservative weekly cash flow, you stop looking at your growth assets as food. You stop pulling up your brokerage app every time the market coughs. You stop measuring safety by whatever financial influencer looks the most confident on camera that week. The person who has no floor is always one bad quarter away from becoming a seller. The person who has a floor becomes harder to scare. That is the identity flip. Most people think the rich live differently because they own better assets. Very often they live differently because they are not forced into the worst timing decisions. That is why I say the first job of a portfolio is not to maximize your excitement. It is to preserve your power to choose. Once that foundation exists, then and only then do I think it is reasonable to ask whether you want to stretch for more income from more complex structures. But even here, the principle does not change. Every layer above the floor should be understood as risk capital. You are not building your life on it. You are building optionality on it. This is where I think many investors lose the plot. They hear about higher yield products, weekly option, income structures, tech-based payout machines, the possibility of forcing a more aggressive cash stream from volatile sectors, and they jump straight there because the basic instruments feel too modest. But modest does not mean weak. Sometimes modest is what allows the rest of the machine to function. A house does not stand because the chandelier is impressive. It stands because the foundation is boring. That is true in construction. It is true in capital allocation. It is true in life. I have lived long enough to see people become fascinated by surface level cash generation while remaining totally blind to balance, sheet risk, duration risk, reinvestment risk, tax leakage, fee drag, and product mortality. They think the future will honor their spreadsheet because the current distribution rate is seductive. But income products live in the real world. Real rates move. Demand changes, flows change, market conditions kill fragile ideas. If you chase a distribution without understanding the source, you are not collecting income. You are leasing confidence from a stranger. I would rather own less and understand it more. Now let us talk about compounding, because here too people often miss the point. Receiving and reinvesting a dividend every 7 days instead of every 30 can produce a real mathematical benefit over long periods. The faster capital returns to work, the better. Compounding does care about time, and small differences repeated many times can become material. But the advantage is only meaningful if the capital itself is not being impaired by foolish risk. People love to talk about faster compounding while standing on a weak base. That is like bragging about how quickly a leaky bucket can be refilled. You do not need weekly compounding on top of unnecessary stupidity. You need sound structure first. Then frequency becomes a bonus. I also want to say a word to the middle-aged investor who hears all this and thinks the whole thing sounds too conservative, too careful, too slow. That reaction usually tells me the person still thinks like an accumulator rather than a distributor. When you are young, the main danger is underinvesting. When you are older, the main danger is underestimating fragility. At 25, it is easy to ignore sequence risk because time can often heal mistakes. At 65, time is not the only variable anymore. You may still have years ahead of you, but you do not have the luxury of pretending that a deep drawdown followed by a multi-year wait is emotionally or mathematically trivial while you still need to pay for food, taxes, medicine, and all the ordinary costs of being alive. A weekly floor changes that math. It will not solve every problem. It will not make a weak plan strong, but it can stop a decent plan from being sabotaged by impatience and forced selling. That is no small thing. When I look at these Treasury-backed weekly pay structures, I do not see a miracle. I see a toolkit. WK gives you a straightforward short bill ladder and a weekly rhythm. MNKT gives you extremely liquid government exposure and emergency, fund utility with a pulse. TLDDR gives you another front-end Treasury tool with a bit more management flexibility. CL gives you a more speculative rate. sensitive satellite for the person who knows exactly why it belongs and exactly how small it should remain. Those are different jobs. Use them for the right jobs, and they are helpful. Use them to chase an identity, and they will eventually embarrass you. The central error in personal finance is not lack of intelligence. It is mismatching tools to tasks. People use debt as though it were income. They use houses as though they were checking accounts. They use growth assets as though they were emergency reserves. They use high yield funds as though they were pension replacements. Then when trouble comes, they call it bad luck. Very often it is just bad architecture. What I would build instead is simple enough to say in a few sentences and hard enough to follow that most people will still ignore it. First, determine what level of weekly cash flow would meaningfully reduce your need to sell anything in a bad market. Not what sounds exciting, what is useful. Second, fund that amount with the least heroic structures you can find. Third, understand the tax consequences before you congratulate yourself on the yield. Fourth, only after the floor is secure should you consider riskier layers for bigger income. Fifth, never confuse a temporary payout advantage with permanent portfolio wisdom. And finally, review the tool itself, not just the story attached to it. Products come and go. Principles endure. There is one more psychological benefit to weekly income that I think deserves respect. It retrains the investor to think like an owner. An owner asks, what is this asset paying me? How durable is the source? How likely is it to remain there? How exposed is it to forces I do not control? And what role does it play in the total system? A speculator asks, what is the headline number? How big is the yield? How fast can I scale it? And what video told me it was easy? Those are different minds. Only one of them tends to stay rich. If I were speaking to someone who feels behind, someone worried that they need a giant portfolio immediately in order to ever feel secure, I would tell them something that sounds unglamorous and is therefore usually true. You do not need your portfolio to impress anybody. You need it to carry part of your life without breaking. That may begin with one safe weekly payment. Then a year later you notice that certain ordinary bills are no longer funded by your labor alone. That changes a human being. You begin to walk differently when some portion of your life is supported by capital rather than by constant motion. The paycheck from labor and the paycheck from assets do not feel the same in the nervous system. One says you are still running. The other says the machine is beginning to run with you. That is the beginning of real freedom, not a screenshot, not a boast, not a yield figure designed to make strangers envious. Freedom. And freedom always begins with a floor, not with a fantasy. So if I were building a weekly income portfolio in this environment, I would start with the humblest truth and refuse to move off it. The purpose of money is not to perform tricks. The purpose of money is to improve your behavior under stress. A properly built weekly floor does exactly that. It lowers the odds that you will sell at the bottom. It shortens the distance between patience and practicality. It gives your growth assets room to grow. It gives your mind fewer reasons to panic. And it reminds you of something I wish more people understood before they ever chase a giant payout. The first dollar of dependable income is worth far more than the 10th promise of spectacular income. One changes your life, the other usually changes your mood. I know which one I would rather build around, and if you want a test to carry with you after you put this page down, here it is. The next time the market drops hard and fear spreads like smoke, ask yourself one question: am I going to be forced to sell something valuable to get through the month, or have I already built a machine that pays me enough to stay rational? Your answer to that question will tell you whether you own a portfolio or merely a pile of assets. The difference between those two things is the difference between being rich on paper and being free in practice.